On today's episode, we are going to take a look at two stocks that you should add to your watch list right now. The first company we're going to take a look at is one that is a SPAC merger actually, and unlike most of the SPACs, this is actually making money right now. They have plenty of revenues, they are profitable and adjusted EBITDA as well, and some people might call this an NFT play, but even though it could be an NFT play, I think it is valued properly for the market it's hitting. The second company we're going to take a look at is an e-commerce giant that recently went IPO. It's growing at some crazy levels. Like always, we're going to take a look at what they do, we're going to look at their fundamentals, and just share my overall thoughts. If this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up and follow me on Twitch where I live stream, taking a look at stocks you want me to look at. So let's get started. But before we begin, let's take a listen to today's sponsor. I want to thank the Motley for sponsoring this video. The Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the stock advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Alright, so the first company we're going to take a look at is one that's going to merge with TOPPS, and TOPPS is mainly known for their collectible game. We're going to find out a little bit more about the company in a bit, but first let's take a look at the SPAC company. So this is Motley Capital Acquisition. It is traded under the NASDAQ as ticker MUDS. As I'm recording this video, it is sitting at $11.23. It is down about 2% from the day. Yesterday the news came out, and after the news, the stock has jumped up about 13.7%. First thing I'm seeing, yes, the company is a little bit excited, or investors are a bit excited. That's why the stock price has jumped. But SPACs are not getting the type of love they were getting about in December a few months ago, where they were jumping about 40-50%. And I'm liking that, right? When they jump that high, you increase the risk when you buy those companies, right? Because they have a faster chance of dropping down. So even though it has gone up 14%, I still believe there's some form of value in this company. And like I mentioned, this is one that's already positive in revenue, and it's already profitable to some extent when we're taking a look at EBITDA values. So the company is expected to go public at $1.1 billion valuation, and we're going to take a closer look at this pro forma usage of cash. A little bit of a red flag here, but I'll hit it in a bit. First, I want to see how this company is making revenue, right? In 2020, they made about $567 million. So the first thing I'm liking right now is that their price to sales ratio is actually about 2, right? Because they're valued at about 1.1 billion, and they made about 567 million just in this past year. They are adjusted EBITDA profitable at $92 million. If we take a look at where they're making the revenue, 65% of the revenue comes from sports and entertainment, and a big portion of that is from their physical market. 55% of the revenue comes from there, and this is like the collectibles they sell. A lot of them selling on stores, on e-commerce, from sports, and from other type of entertainment platforms. Another 6% of their revenue comes from digital market. The digital market, they do have some form of interactive apps where they make money here, where players are able to trade their cards. The next is 4% of their revenue comes from gift cards. And I thought this was pretty interesting, right? I wouldn't have expected them to be hitting this market, even though it's such a small portion of their revenue. They do have some big players here. Finally, the other 35% of the revenue comes from confections. This is pretty much edible entertainments. You have like Ring Pops, Push Pops there. Those are some big names. So we can see they're very diversified. For me though, this company, even though it has all these different aspects, I'm looking at it more as a collectible thing. So like I mentioned, right, this is a company that a lot of people are calling it an NFT play. And the first thing I wanted to make sure is that this NFT play wasn't new, that this is something that they weren't just doing now because of the hype. And if that was the case, I would have kind of had some red flags in there. But that is definitely not the case, right? NFTs were launched on May of 2020 for Topps, right? And they did pretty well. So it's telling me, so May 2020, this is way before the time everybody was talking about NFTs. So it's telling me this is a movement that Topps has been thinking about doing before the whole craze. And that gives me a great plus or great tool on the management. I do believe this overall digital aspect in the blockchain and NFT innovations is a great move for the type of products they provide. Next, I wanted to take a look at their revenue growth, right? In 2019, they didn't grow that strong. It was 2%. In 2020, they grew about 23%. We're seeing a lot of, I would say, influencers talking about the collectible market. I've been very bullish in the collectible market. I recently bought PSA, which was Collectible Universe, and they were one of the true players, I thought, in the overall collectible market. Unfortunately, they ended up going private, so I no longer hold them. And now after that, I think Topps is probably the closest play to that market. But in 2020, they grew 23%. In 2021, they're expected to grow 22%. And in 2022, they're expected to grow 12%. Another thing is they are adjusted profitable EBITDA margins, and they're pretty constant with around 15%. One thing though, I also wanted to see, right? We're seeing this strong revenue growth. I wanted to make sure that this revenue growth was not only coming from the NFT place. I wanted to see out where it was coming from. And the great thing, again, if it was only coming from the digital side, it would have been another red flag for me. Again, this company is looking like it's not hitting those red flags for me, so I'm enjoying it. The digital, most of this money is going to be coming from the fiscal aspect and the confection aspect, so the edibles. And that's where most of the revenue is going to come from 2021 and 2022. They are expected to see growth in the digital and gift cards, but not at some crazy value. So this is telling me that management is not trying to overhype this NFT play, which is something I'm happy to see, because yes, it could be a future, but management doesn't really see how much of a future it can grow. So they're giving some modest guidance. So next, what I wanted to take a look at was this company's valuation at that $1.1 billion. And they show here a chart with other companies in different markets. Remember, we have Topps, they're in the collectible, they're in the edibles, they're in sports entertainment, they're in the digital. But at the end of the game, I personally call Topps more of a collectible play. So I just want to take a look at those numbers. The medium, when taking a look at EV to revenue for 21 revenue guidance, is about 2.4%. Topps is below the medium at 1.9%. Very similar to EV to EBITDA margins. The medium is about 13x, when for Topps is about 12.5. So again, below the median. So this is telling me one thing, that the company is not overvalued, but at the same time, it's not undervalued. And I do want to say, because of the market it's in, I'm really happy with how the price is reacting right now. So the biggest red flag for me is what's going to happen with the PIPE proceeds and the SPAC cash in this account. So right now we can see PIPE proceeds is going to be 250 million. And cash in the SPAC account is 321. So this company, in theory, is raising $571 million. Unfortunately, none of that money is going to Topps. It's going to go to cash to selling shareholders. So insiders are selling this company. Most of that money is going to go to those shareholders. People are wondering, why are so many shareholders selling, right? And the second 50 million is going to go to fees and expenses. So the whole 571 million that this company that the SPAC is raising is not going to go to the company. So that's a red flag. But remember, this is one that's profitable in adjusted EBITDA. And it also has about 50 million in cash in their balance sheet already. Unfortunately, I wish they would have used some of that money to pay down some of that debt. They have about $200 million in debt right now. But remember, this is different from some of the other SPACs we've seen, where some of these other SPACs, they need to build up that cash because they don't have revenues right now. They're not expected. They're continuing to burn cash. So it's different positions. Again, I wish the story would have changed there a bit. All right, so the second company we're going to take a look at is an e-commerce giant in South Korea. And this is Coupang. It is currently traded in the New York Stock Exchange as ticker CPNG. It's currently sitting at $45.65. and it has a market cap of $80 billion. I do think the biggest red flag we're going to see here is kind of valuation. People might believe 80 billion is a bit expensive for this company. There might be some, I want to do some counteractive arguments to there. So Coupang just recently went IPO'd, and since its all-time highs, the stock is down about 8%. It IPO'd at $35, but the closing price on IPO day was about $49. So Coupang, like I mentioned, is a typical e-commerce here. You can see it. And just like most e-commerce, they have like form of membership fees that you can pay to get special form of delivery, next day delivery, and so on. Then they also have Coupang Eats. Coupang Eats is their food delivering platform. And one thing that I like about Coupang Eats a lot is because they're doing super well with the logistics in their shipping department, their e-commerce department, I believe that would work well. It works well with Coupang Eats. In the future, I can kind of see them doing some form of maybe ride sharing application as well, because it kind of needs that similar type of logistics with it. Taking a look at top overall apps in South Korea, and unfortunately Coupang is only hitting South Korea right now. We can see Coupang is actually in the top 10 apps. Coupang Corporation or Coupang Eats is number 7 in South Korea in iOS, and Coupang, the e-commerce, is number 13 as of April 6 of 2021. So now let's take a closer look at Coupang. One of the major things that Coupang does is they call dawn delivery. You can order a million of items before midnight, and they will arrive at your door before 7 a.m. So quick shipment. They also have zero packaging. They kind of eliminated a lot of the boxes. Over 75% of parcels are now come in eco bags instead of cardboard. And I think that's actually pretty impressive that they were able to do that. And now the question is, how are they able to do that? How are they able to do almost 6-hour shipment? And the reason is that they designed over 100 unique fulfillment centers covering 25 million square feet and housing millions of products. This translates to 70% of Korean population living within 7 miles of Coupang's logistics centers. So because they have such a huge portion of the population within the Coupang logistics centers, they're able to produce these types of products. And today, Coupang is the largest product e-commerce player in Korea. But even though they still remain a small percentage in the company's total retail, grocery, consumer food services, and travel spend in the Korean market. So they believe this is a market that they can continue to grow. If we take a look at the revenue growth in 2020, quarter 1 saw 90%, quarter 2 saw 94%, quarter 3 saw 95%, and quarter 4 saw 93% year-over-year revenue growth. Analysts did come and play and gave some form of ratings to Coupang. Right now, most of them are giving it a hold or neutral. There are 5 analysts. Only one gave it a buy and gave it a 62 price. The average price is about $48, still higher than the current price right now for the next 12 months, but many believe it's not going to be a huge grower. So if we take a look at Coupang, Coupang is expected to grow its revenue 22% on average for the next 2 to 5 years. Unfortunately, they are not profitable, but they are positive in cash flow from operations, and that's great to see for the overall e-commerce world. If we take a look at historical values, their profit margins for 2020 were negative 4.7%. We can see they are close to profitability, and another thing I'm happy to see is they are growing. In 2019, those margins were negative 12%, and in 2018, they were negative 27%. So we're seeing improvement in margins, and I do believe maybe in the next 2 to 3 years, they could achieve profitability. Next, I want to take a look at their balance sheet. Balance sheet looks okay. I wish it would have been a bit stronger. They have about 1.3 billion in cash and about 1.2 billion in debt, but they also have about 1.2 billion in inventory. So again, the balance sheet, I wish they had less debt and more cash, but it is a company that is positive in cash flow from operations. So now I wanted to take a look at future ratios. Quick look, for December of 2022, this company is expected to make about $26 billion in revenue. That gives us a forward price to sales ratio of about 3. I think that forward price to sales ratio is pretty cheap. This is normally what you end up seeing in the overall retail e-commerce side. So I don't believe the company is overvalued. And with this strong logistics that they have, it's one that can continue to grow at strong levels. Now, just my overall thoughts on the company. I am pretty excited about both of them. I do believe they're both in great markets. So let me know in the comments, which one did you guys enjoy more? Did you guys enjoy the collectible one, the collectible SPAC, or the e-commerce giant? So take care, guys. Have a good night and see you next time.